And Mark Mobius, chairman of Mobius Emerging Opportunities Fund. Mark, it's great to have you back on the show, and that's exactly where I want to start. With the Fed cutting by 50 basis points today, what does this now do to opportunities in emerging markets?
Well, first of all, you've already seen a number of emerging market currencies strengthening against the U.S. dollar. Taiwan and Thailand up 10% or more against the U.S. dollar. So their currencies are getting stronger. And of course, they anticipated the rate cuts. And that's the reason why this started to happen about 2 months ago. So that's the first thing. The second thing is that a lot of these emerging market stock markets are performing much, much better than the U.S. market. If you look at Taiwan, if you look at India, you'll see that those markets have outperformed the S&P 500 over a 5-year period. So I think you're going to see more and more of that in emerging markets as money flows back into these markets. You must remember now that the tech trade is over, and once everybody pays off their bills in Japan for the yen that they borrowed, they're going to be looking for a new risk. And of course, with interest rates lower in the U.S., the U.S. will be less and less attractive, and you're going to see more money flowing overseas. Of course, not only in emerging markets, but in Europe as well.
We talk a lot about buy the rumor, sell the news dynamics in the markets. The fact that we've already seen some of these moves in anticipation of the cut we got today, how much more value is there to be extracted? Where would you be putting money to work based on that right now?
That's a very good question, because if you look at value by the looks of India, for example, although I've been very bullish and still I'm bullish on India, you'll see that on a PE basis, it's pretty expensive. But we don't pay attention so much to PEs only. We look at growth as well. You got to look at the E instead of the P, or in combination with the P. So there's still lots of opportunity in India because of the growth. But then you've got opportunities in Taiwan, Thailand, Indonesia, Korea. And, you know, a number of these countries are going to do very well. Interestingly enough, the so-called basket cases in terms of debt, Mexico, Brazil, South Africa, Turkey, these countries will begin to benefit from the cuts in interest rates because their debts, their U.S. dollar offshore debts will be easier to pay off. So their markets will begin to do better than they have been up to now.
Mark, I thought I remembered you being more cautious on international markets ex-India the last time we talked. Has that shifted with this 50 basis point cut?
Yes, definitely. I was very leery previously, except for India, but now I'm much more bullish because of these rate cuts and the general dynamics of how money in America is going to be flowing outside. And let's remember, the biggest pool of money is in the U.S. And if U.S. investors begin to get more interested in what's overseas, emerging markets are, of course, going to benefit.